Shri Gurubhyo Namaha. So, in the series of videos that we are doing on CMA Part 2, let's start in this video. Let's start with understanding what are the contents of, Section B of, Section B of CMA Part 2, which is Corporate Finance. So, this section is for 20% of the marks. That means 500 into 20%, which is 100 marks for your CMA Part 2 examination. So, first of all, we need to understand something about Section B of Part 2. So, 2B or B2, whatever your 2B is better word. So, 2B, Section B of Part 2, this is similar to 1A, Part 1, Section A, where this is basically one of the largest sections of both the parts. So if a student asks me like what is the most voluminous topic or a section, then that would be Section A in Part 1 and Section B in Part 2. Okay, so just for you to have a quick comparison, so if I see at Part 2 index, Section A has 4 units, then Section B has 6 units, Section C has only 3 units, Section D just 1 unit, risk management, and Section E has again 2 units, and Section F 3 units. So you can see that Section B is the most voluminous section amongst all the Part 2 sections. So now what is the content covered in this CMA Part 2 Section B Corporate Finance? So as the title suggests, this is regarding the finance. This is where you start talking about financial management. Okay, so what is covered in this? So here we are going to talk about from where the company gets its funds. Okay, so for example, company can borrow money, company can issue equity shares, companies can issue preference shares, they can borrow money in the form of leasing of assets, all that stuff. So in the 6 units of Section B, the first unit we talk about risk and return. Okay, so in short, if I have to keep it very simple and something interesting for most of the students, recently in the IPL 2020-24, RCB has lost 6 matches in a row, right? So at that point of time, when RCB lost 6 matches in sequence, the percentage of chances for RCB to go into quarterfinals and qualifiers is less than 1%. The chances of RCB qualifying is less than 1%. But after that, magically RCB has won 6 matches in a row. After losing 6 matches in a row, RCB has won 6 matches in a row, and they beat CSK in the qualifier elimination, whatever match you want to call it as, so knockout match. So they beat CSK by more than 20 runs, and then with the help of net run rate, they went into the qualifiers. So here, what I am trying to make you understand is that if at all somebody wants to make a prediction of RCB going into quarterfinals or RCB going into qualifiers, okay, so the risk in that would be very high. They have less than 1% chances of happening. So if somebody is going to say that RCB will go to qualifiers, then that is a very, very, very risky situation. But imagine what their returns would be. See, if I'm talking about betting, see, I am not here to talk about law or ethics and stuff like that. I am, in this particular example, I'm only focusing on making you understand the risk and return relationship. So if at all there are IPL bettings going on and RCB chance of going into qualifiers is less than 1%, okay, so the bettings in this case might be something like 100x or something, sorry, the 1 is to 100 or 100x, whatever. So if somebody is betting 1000 rupees, then their return would be 1 lakh. Okay, so here what is happening, because the risk is so high, the return is also very high. So we are going to understand risk return relationship. Okay, and we are going to also understand the different types of risk that are there in the business, like for example credit risk, foreign exchange risk, interest rate risk, market risk, competition risk, systematic risk, unsystematic risk. We are going to talk about all the different types of risks. We are going to talk about how to calculate the return on an investment. We are going to understand the relationship between risk and return. That is our first what do you call, the unit 1 of section B. Then moving on to the unit 2, that is long term financial management. So the term itself is very clear. This is regarding long term financial management. So what is covered in this? So here we are going to understand the term structure of interest rates. So interest rates, again, you have different types of interest rates. You have fixed interest rate, you have floating interest rate. Okay, then there are pegged rates. So if I have to keep it even simple, very simple, if you go to any bank website, okay, any bank website, and if you search for FD interest rate, all right, let's quickly go through that also once. So if I go to any bank website, I'll bring up Edge, and let's say ICICI FD rates. You can search any bank, doesn't matter. So I'll go to this. Okay, so here if I scroll down a little, you can see this particular table. This is what I'm talking about. So if you are investing an FD for 7 days to 14 days, that would give you for normal citizens, not senior citizens, or what is this? Why do they have less than 2 crores and 2 crores to 5 crores? This is less than 2 crores, this is above 2 crores but below 5 crores. All right, so let's not worry about the second part of it, about 2 crores. Suppose if I want to make a fixed deposit of 10 lakhs, so less than 14 days they'll pay me 3%, and up to less than 30 days 3%, 30 to 45 days 3.5, 45 to 60 days 4.25, 4.5, 4.75, 5.75, and then 6 percentage 6.7 if it is more than 1 year. So here you can see, as the term is increasing, the interest rate is also increasing, but there is exceptional case here. If your term is increasing more than 2 years, see here 5.75 to 6, then 6 to 6.7, 6.7 to 7.2, but here 7.2 to 7, 7 to 6.9. Here it is reducing, here it is increasing. So the interest rates would be different for different periods. Okay, why does that happen? We are going to discuss in the lectures. If I talk about everything here, the index lecture itself will go into 5-6 hours. So I'm not going to talk more about that beyond that. So we are going to talk about the term structure of the interest rate. Then we are also going to talk about different types of financial instruments. So here we are going to talk about equity, you are going to talk about preference shares, we are going to talk about bonds, we are going to talk about options, we are going to talk about features, we are going to talk about forwards, all the different types of financial instruments we are going to discuss in the types of financial instruments. Then the concept of cost of capital. If a loan is there, for example, if this loan you are getting at a rate of 8% rate of interest, but when you pay this interest, your taxable profit will fall down, right? Interest is a chargeable expenditure. So when you pay that expenditure or when you incur that expenditure, your profit would come down. So if your profit is less, your tax also would be lower. So even though you are paying 8% rate of interest to a bank, that interest will save you some tax amount. So let's say the tax rate is 30%. So by paying 8% interest, you can save 30% of that 8%. That means my net cost of capital would be 8% into 1 minus 30%, 5.6 percentage. So that is how we calculate cost of capital. This is just one example where I covered cost of capital of debt, after tax cost of capital of debt, to be more precise. But then we are going to discuss the cost of equity, cost of debt, and cost of preference and all that stuff in your regular classes. And then we are also going to do something called as WACC, weighted average cost of capital. Okay, when a company gets funds from different sources, let's say we are requiring $5 million for a project. Out of this $5 million, I got 2 million from equity, I got 1 million from preference, and I raised 1 million from corporate bonds, and I took 1 million loan, right? So the total funds raised are 5 million. So each of these will have a different cost of capital. So we are going to calculate a weighted average cost of capital to evaluate whether a particular project or a proposal is profitable or not. So that is WACC concept covered in cost of capital. Then we are also going to discuss about different valuation techniques of different types of financial instruments. So here we usually use the DCF technique, discounted cash flow technique, and we also use CAPM model, capital asset pricing model. So discounted cash flow is where, if you have a project that is running into say 4 years, 1, 2, 3, 4. So we bring all the future cash flows to their present value. Then we calculate the sum of all inflows minus sum of all outflows, present value of inflows minus present value of outflows. If that is a positive value, then that is a favorable project. If it is a negative value, that is a unfavorable project. So we are going to use the discounted cash flow model, which is basically similar to NPV calculation, net present value calculation. Again, we are going to discuss in detail in the lectures. Let's not do that here. And CAPM, capital asset pricing model, here we are going to talk about systematic risk versus unsystematic risk. This is a very interesting topic. How a particular risk affects the overall market versus affects only a particular segment of the market, that is systematic and unsystematic. We'll cover in the regular lecture. Then the third part of section B covers about raising capital. So what do we mean by raising the capital? Raising means getting the funds. So if a company is planning to get some funds, from where can it get? So it can get from different financial markets. See, there are a lot of scams that we have seen across the globe. There is Enron, which is a benchmark scam. Then there is WorldCom. Then there is Satyam Computers in India. There is Kingfisher Airlines. So 2G scam, 3G scam, all this nonsense are again there. But Kingfisher is one of the interesting case laws in India, because Satyam Computers, they made fraud with the company money, right? Enron, sorry, not Enron, Enron. So Enron, they made scam with the funds of the company. But Kingfisher is a different level of swag. They did not make fraud with the company money. They made fraud with the bank's money. So they took loans from different banks, and there was a point where consortium lending was done. Consortium lending means basically one bank is unable to give the total loan amount. So 4 or 5 banks will come together to give loan to a single company. So Kingfisher, at one point, consortium lending has been done to give loan to Kingfisher. And then they took that money, and then they ran the company into losses, and all that nonsense happened. But anyways, so to prevent these kind of frauds or scams, or to prevent people from losing money, there are some regulations in the market, financial regulations. Like in India, you have SEBI, Stock Securities Exchange Board of India. You have SEC in US, Securities Exchange Commission, right? So there are different regulatory authorities or regulatory bodies to prevent these kind of frauds from happening. Then we are going to talk about market efficiency. Market efficiency means how quickly the information is available to the public as a whole, whether everybody is having the same information at the same time, or whether some people are getting insider information before everybody else. So there are some levels for that. We talk about perfectly efficient market, then we'll talk about semi perfect market, or inefficient market, and all that stuff we'll discuss in the class. So that is also called as strong form of efficiency, semi strong form of efficiency, and weak form of efficiency. Then different financial institutions that are there. So what are credit rating agencies that give you a civil score or experience score? Suppose if you apply for a credit card, so the company will look for civil score. If the civil is above 650 or something like that, you can get better loans and stuff like that, whatever not, right? And then initial offering, IPO, and secondary public offerings, SPOs, are also called as follow up public offering, FPO, right? So we have seen lot of IPOs coming that came recently after lockdown. The most what do you say, interesting one was Zomato and Paytm. These two are very interesting IPOs that have been seen. Anyways, let's not go into the details of why I call them as interesting, because that itself would take 15-20 minutes of discussion. So I'll try to avoid that. But if you see the stock price, then you'll definitely understand why I say that it is one of the most interesting this thing. So quickly, I'll just open Zomato. Or if even if I see the uh, Paytm also, that would be very interesting. Paytm is a different story. So you can see here, if I see the overall, Zomato has given a return of more than 45% since its inception. But then, if you really see, it was started at 105, 107, and then there was a point where it was trading around 60 rupees, 62 rupees, and the 52-week high, the highest was 207. So you can see the price difference. It's more than 3x in the last 2 years itself. From 62 rupees it went up to 207 rupees. And similarly if we see Zomato, Paytm is a horror story. For people who invested in Paytm, they would understand why I call it as a horror story. So you can see here, Paytm had a high of uh, more than 1700. It was somewhere close to 1800, and today it is trading at 344 rupees. It lost almost all 78% of its share price since inception. Imagine someone who purchased the IPO at 1800, and today their share price is 345 rupees. So that's a huge loss that they are sitting on, right? So anyways, so that's about initial public offering, IPOs, and follow-up public offerings for FPOs, secondary public offerings. Then whenever you invest in some shares, they'll give you dividends. That is called as the dividend policy of the company. How much dividend should be paid, what is the rate of dividend that should be paid, and stuff like that. And share repurchases, company can buy back its own shares. When the company has surplus funds and too many shareholders, companies usually buy back their own shares, which is called as repurchase of shares. And then we have a concept of lease financing, whether a company should go for buying an asset, or whether they should take an asset on lease. How do we do the comparison calculations and all? In section B, unit 3, there is a new topic that is added, that is a debt financing versus equity financing. So what are the advantages of going for debt versus what are the advantages of going for equity? That is a newly added topic in your syllabus. Then moving on to topic number 4. So topic number 4 is called as working capital management. So what is working capital? Working capital is nothing but the money which is required for running the day-to-day business operations. Like for example, payment of salaries, payment of utilities, electricity bill, rent, maintenance, all that stuff. Then payment of your internet, telephone, transportation, all that stuff. So purchase of raw material, and then you get some funds by selling your product to your customers and collecting from the customers. So all the day-to-day operations, the regular business operations of your company are called as working capital. So in that you have some terminology that you need to understand, like basically gross working capital versus net working capital. So if I remember right, this was one of my questions in my MA examination or MBA exam. I don't remember which one it was, but in one of my examinations, I had gross working capital versus net working capital as a question. Then similarly, we are going to understand about cash management. So cash management means whether a company should pay the vendors upfront, or whether they should wait a couple of days or couple of weeks to make the payment. So how much discount they can give to their customers to make them pay faster. And then we have something called as logbox system. So we are going to talk about that in cash management, all that stuff. So how should a company manage its cash balance? And remember, cash means cash and bank. Like in India, you don't have cash account, bank account and stuff like that. Cash includes bank balances as well. Then marketable securities. Marketable means something that you can quickly sell in the market when where there is a ready open market for that, like basically equity shares or G-Secs, government securities, right? Bonds, again, not all bonds, but maybe something like treasury bonds or T-bills, etc. So marketable securities means something that you can quickly sell in the open market where there is proper demand and supply and a channel for transacting on that. Then accounts receivable. Basically, accounts receivable means in Indian language we call it as sundry debtors. So again, how much discount you can give it to your customers, how many days of credit period can you lend to them, what is the aging schedule of your debtors and all that stuff. Similarly, inventory. Inventory means the stock management, how much stock you should maintain in your godown, at what level should you place an order for replacement of the inventory, and what is your what do you call them, economic order quantity, we call it EOQ, economic order quantity, reorder level, critical level. Then we will also discuss a technique called JIT, just in time technology, or technique, whatever you want to call it. That is basically a system, inventory management system. Okay, all that stuff related to the closing stock. Then what are the different types of short term credit? See, if I go to a bank and take a loan, that is a long term credit. But if I take a working capital loan, we call it as OD, overdraft. So they let you do a minus balance in your bank account, that is called as overdraft. You are issuing checks for beyond your balance, over kar rahe aap log. So that is overdraft, minus balance in your bank account. That is a form of short term credit. Then how do you manage your short term credit? See, if you do not manage your line of credit, or if you do not manage your bankers loans and stuff like that, here we have a lot of topics also, factoring, with recourse, without recourse. Then we have LOC, letter of credit. Then we have hedging versus arbitrage topic. Okay, commercial papers, all that stuff will be there. So if you do not manage your liabilities, it would become a very tricky position for you when you have to pay them at the same time. Okay, then we have this concept of corporate restructuring. This is a pure theoretical concept, okay, relating to mergers and acquisitions. You know, Facebook has acquired WhatsApp, Facebook has acquired LinkedIn, Facebook has acquired WhatsApp, Facebook has acquired Instagram, Microsoft has acquired LinkedIn, Microsoft has acquired GitHub. So there are a lot of mergers and acquisitions that we keep seeing. Byju's has merged with Akash. So there are so many examples that we can take for mergers and acquisitions, right? And then other forms of restructuring. Here we'll talk about internal restructuring. Then we'll also talk about leveraged buyout. Okay, how you can buy out your competitor or whoever it is. If you're trying to acquire another company by taking a loan, that is called as a leveraged buyout. And then we'll also talk about different types of mergers: horizontal merger, vertical, not just merger, but any type of merger or acquisition, horizontal, vertical, conglomerate types of mergers. Then we'll also, this is one of my very interesting concepts, that is defense against hostile takeovers. If somebody is trying to acquire your company and you don't like that, so what you can do to prevent somebody from forcefully acquiring your company, forcefully taking over your company? So what are the different strategies that you can use to defend yourself from a hostile takeover? White knight approach, or else poison pills, golden parachutes, all that stuff will be there. If you guys watch this TV show called Suits, Suits. It's on Netflix and Amazon Prime, if I remember right. So, Suits is an excellent show regarding an entire world of lawyers, law firm. So, you will find most of these words: golden parachute, staggered rights, voting rights plans, white knight approach. All that stuff will be already covered in those. Anyways, that's not our point of discussion, but yeah, those are your two concepts in section B, unit 5. Then talking about the last unit, which is international finance. So when you start talking about international, the first question that comes to your mind is exchange rate. So for example, $1 is equal to INR 83.5 as of today. Similarly, one pound, sorry, 1 pound is equal to dollar 1.3 or something, if I remember it right. But anyways, yeah, so this exchange rate, how is it determined? Who fixes the exchange rate? Who is sitting somewhere and telling that, okay, today dollar is 83.5, and then it fell down to 82 and then it increased to 84? Who is deciding that? So there are different types of exchange rates. There are fixed exchange rates which do not change. There are flexible exchange rates, somewhere between fixed and floating. Floating means completely left to the market forces of demand and supply. A flexible is somewhere between these two. It's not fully fixed and it's not fully floating as such. So we'll talk about those. And then transaction versus translation. If I'm going to an airport and giving uh, 10 lakh rupees and asking them to convert that into dollars, that is called as a transaction, where an actual exchange of economical value is going on. Where on the other hand, if I'm preparing a consolidated balance sheet, subsidiary is in let's say GBP, and the parent is preparing its financial statement in dollars. So all the GBP values should be now converted into dollars to do the balance sheet preparation. So that is called as a translation. Transaction versus translation. That is one topic that we'll cover. And the last one is, how do you get finance for international trades? So there are so many special financing methods that are only suitable for international trade, basically like your LOC, letter of credit, then you have your BS, bankers acceptance, you have forfeiture, counter trades, money market hedge. All this stuff are available. These are specifically money market hedge you can do for local transactions also, but yeah, these things are specifically for international trades. Okay, so that is your section B of CMA part 2. This is one of the most lengthiest topics of CMA part 2. So I would recommend doing this maybe at the later point of your preparation. Do not start with section B is what I would recommend. But if you are of the opinion that, sir, I'll tackle the biggest bully first, then that's good, your wish. It all depends upon your strategy for cracking the examination. All right, so I'll see you in the next video with subsequent lectures. Until then, keep smiling, take care, bye bye.